Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, this is Shiraz Mian with the top stock video of the week. With me is Nina Mishra, our ETF strategist. Nina will be sharing a cloud computing stock. Mine isn't that glamorous. It's more of the traditional operator. I'm sharing Walmart, ticker WMT. Walmart obviously needs no introduction to anyone in our audience, and its traditional business is also well known. But the reason I'm featuring Walmart is to think of this company and this stock as the true competitor to Amazon in the digital e-commerce space, both currently during the COVID-19 period of disruptions, but more importantly, beyond that phase. And we have seen all the gains that Amazon has benefited from, not only during this period of disruption, but over the last many years. None of that has happened, or it hasn't happened for the most part with Walmart. And I strongly feel that folks who would commit to the Walmart stock with the digital side of the business as the core reasoning for that decision would benefit in the long run. On the traditional metrics, both fundamental in terms of operations, profitability, financial health, and to a large extent valuation too, the stock screens reasonably well. We know Walmart has been a conservatively run company with a fortress balance sheet. Profitability over the last many quarters has been affected to some extent because management's very aggressive investing on the digital side of the business. And that, as we have seen that with Amazon over the years as well, could be expensive and has an effect on near-term margins. But if you look past that and look to the long term, where this company, with a slightly different take and different digital model, could be as important a competitor to Amazon, then it's easy to overlook this near-term profitability squeeze. In this period of dividends being under stress and under threat of being cut, it's good to see that you could confidently look at Walmart's dividend at about 1.8% as very safe and a grower in the long run once they are past this current phase of investment in the business. It's obviously a large company, close to $330 billion in market cap. The stock has done reasonably well during the pandemic. It's about flat for the year currently, but on the whole, I see Walmart as an excellent long-term play for the digital economy. So I'll pass it on to Nina now.
Thanks, Shiraz. My pick today is Dropbox, which is a cloud software company. And we know that technology is the best performing sector this year. And within that sector, some areas have done really well, and cloud is one of them. Because this coronavirus pandemic has accelerated the move to the cloud as companies are trying to support their employees that are working remotely. And in fact, major cloud computing companies, they reported surging demand for their products during the recent earnings calls. And of course, investors have been pouring a lot of money into cloud companies. some valuations look quite stretched. Dropbox is one of the companies which is still trading at a reasonable valuation. So Dropbox provides storage for photos, videos, documents, and last year it launched a collaboration platform too, which is called Dropbox Spaces. It's basically a centralized workspace for organizing content, digital tools, communication services communications across various platforms. Now, this is a relatively new company. It IPO'd in 2018, and it reported its first quarterly profit since its debut as a publicly traded company for the last quarter, which was actually a bit sooner than expected. So, of course, investors liked that. Results were better than expected. Both earnings and revenues beat expectations. And the company also recently surprised investors with a stock buyback plan, which is about 600 million, and which is unusual for a young company growing at a fast pace. So there's a lot to like about the company. And now let's take a look at some of the charts. And the first one I wanted to show is price consensus and EPS surprise chart. You will see that the company has not missed at all since going public. It hasn't done much in terms of pricing too. It is still trading much below its debut price. Its price after going IPO a little bit after its debut. But so that is why the valuation also looks reasonable. And let's take a look at detailed estimates. You will see here that the company has been delivering earnings surprises, and analysts have raised their estimates after the recent earnings surprise. And if you look at the earnings growth trend, it is expected to grow its earning by 50% this year and 19% next year, which is pretty impressive. And since it hasn't done much in terms of price surge, it is still trading at a reasonable forward earnings multiple of about 29, and it is a Zacks rank #1 stock. Thanks for watching, and make sure to check out zacks.com/promo for a very interesting deal. And we will have more interesting picks next week. Thank you.